tell you. And especially what's going to make you mad is what we're going to talk about next, because it's oil prices. All of us remember in the summer of 2008 about how oil climbed past $143 a barrel. We actually have an article from a television station back in the East Coast. June 30th, 2008, oil climbs past $143 a barrel. And then oil, let's go to the next article, because the next article it was actually slightly earlier, a few weeks earlier. It talks about Morgan Stanley's oil influence. June the 6th, 2008, it says the latest rise seems to have been driven by a report from Morgan Stanley predicting that oil would reach $150 by July the 4th. And I recall that Morgan Stanley was the single largest holder of oil options on NYMEX. That being the case, was this the work, was the oil and gasoline price increase the work of PDT at Morgan Stanley?
That's an interesting theory. I would not think that could be true, because they generally don't invest in commodities, that one group. There are other groups at Morgan Stanley that do invest in commodities, but PDT generally invests in stocks or currencies. They may invest in some oil derivatives. I'm not really sure, but that's just something I never came across, and I'm not against the idea that there were some shenanigans being pulled on Wall Street in 2008 and 2009 regarding the oil bubble, and there are some theories that the prime suspect is actually Goldman Sachs.
Well, we're going to get to Goldman Sachs here in just a minute. Interestingly enough, we're going to skip over actually to a quote out of your book, page 197. Like crack cocaine, it, being the collateralized debt obligations, was addictive and ultimately ruinous. And then we go to the next person on our list to talk about was Henry Paulson, Goldman, the Global Alpha, and the Quants. You talk about Paulson in the book.
Right, yeah. He was the CEO of Goldman Sachs for many years, and must have been very ironic for him to be the Treasury Secretary when all this stuff blew up, because he presided over this culture of risk-taking at Goldman Sachs, and I found some documents showing that he had written letters to his employees saying that we need to take more risk, we need to essentially make bigger bets.
So is it a fair question for me to say, what did Paulson know and when did he know it?
He knew that Wall Street was becoming very aggressive. I think he bought into this idea that Wall Street had conquered risk, and because of these very sophisticated quantitative models, Wall Street was able to take bigger bets, essentially, because they had hedged out the risk because of the quant formulas. So I think that there was sort of this collective delusion that because of these great advances that had been coming out of the universities and in the creation of derivatives, and the Federal Reserve really knew what it was doing, that there was this idea that risk had been conquered. And Ben Bernanke actually gave a speech in early 2004 called The Great Moderation, and this idea of the Great Moderation was that volatility had reached an almost permanent low, and you didn't need to worry about big swings and big volatile moves because risk had been taken care of. And I think that lured a lot of people into thinking that it was okay to just lever up and shoot from the hip, and Goldman Sachs was right along with that. I think, and then when you looked at the profits that were coming out of Goldman Sachs, I think it became the envy of the rest of Wall Street, and everybody else tried to imitate them. Yeah.
Scott, I've got about 2 hours worth of questions, seriously, and we only have about 3.5 minutes left, so I have to get to this. We are the home out here in the Pacific Northwest of Washington Mutual, and of course in the past couple of days, Washington Mutual has been on the Hill there in Washington, D.C. In fact, Kerry Killinger, the former Washington Mutual CEO, scoffed at lawmakers who blamed him for the largest bank failure in U.S. history, accusing regulators of helping only financial institution deemed too clubby to fail. Well, WAMU is certainly not clubby. Did they deserve to fail?
Well, from what I know about what Washington Mutual was doing, was they were definitely plowing full speed ahead in the subprime mortgage market, and they were engaging in some of the riskiest activities. I don't know all the details about why there was a run of the bank at WAMU. Mm-hmm. It happened right around when Lehman went down, so I think it was one of those systemic things that everybody they were falling like dominoes, and they were probably one of the weaker links. So I mean, from as far as I can tell, Washington Mutual, and I did, when I was researching this book, speak with some people who had worked there, and there were warning signs that things were going wrong there, and that the company was getting too aggressive in the subprime mortgage market, and the board of directors apparently wasn't listening to these warning signs. Did they deserve to fail? I don't know. I mean, everything in late 2008 became so crazy that I think companies that had been trying to manage their risk became, even Goldman Sachs nearly went down. Morgan Stanley almost went down.
Yeah, and a lot of people are saying maybe they should have. Scott, your book is so fascinating that's why I'm having a hard time with the interview, because I want to ask you so many questions, but we have only time left to talk about dark pools and where these quants are today, because you say that they're still out there, still doing stuff that maybe you're going to be writing another book about.
Right. Yeah, there's no question, these guys are going full speed ahead. This is the career they've chosen, and there's plenty for them to do. And one real hot area that I've started writing about for the paper recently is high-frequency trading and also dark pools. They're two different things, but they overlap sometime. High-frequency trading is using super-fast computers to trade. These guys send thousands of orders to stock exchanges per second. They're trading at speeds measured at microseconds, which is a billionth of a second.
So it's not about management. It's not about the true worth of the company anymore. It's about this math formula that these quants can somehow create. And so they're essentially creating a market and creating a value of a company that doesn't truly exist.
They're using speed to go in and out of stuff faster than you can possibly imagine. They have self-justifications for what they do. They say they're providing liquidity to the market, and I think sometimes that may be true, but I also hear that traders that are trying to just buy a stock because they like its value are having a lot of trouble because they think they're getting gamed.
And with that, Scott,
a lot of times they think they're getting gamed in the dark pools, which are off-exchange crossing networks.
And Scott, we've got to make that the last word. Thank you very much for being with us. Scott Patterson, the book is The Quants, How a New Breed of Math Whizzes Conquered Wall Street and Nearly Destroyed It. ScottPattersonReports.com. We'll see you next week right here on Public Exposure. Take care.